FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B.R. Preetham, Group CEO, Sansera Engineering Limited. Thank you, and over to you, sir.
Thank you, Aman. Good morning, everyone. Happy New Year. This is the first call that we are doing after this New Year, so Happy New Year to all of you. Welcome and thanks for joining this call. I hope everyone is safe and healthy. On this call, I am joined by our CFO, Mr. Vikas Goyal, who is with me here in our Bangalore plant, and I am also joined by our Head of Operations, Mr. Praveen Chauhan, who is dialing in from our Delhi office. And we have our Investment Relationship Advisors, SGA team on the call. The results and the presentations are uploaded on the stock exchange and company website. I hope everybody has had a chance to look at it. To begin this call, I will give you a quick snapshot of our company, and then we will walk you through some of the recent developments and our operational and financial performance. Sansera is an engineering-led integrated manufacturer of complex and critical precision engineered components. We cater to a large number of OEMs across 25 countries with various products in both auto and non-auto verticals. We have 17 manufacturing facilities equipped with high-end fungible machines, the majority of which are built in-house by our own team of experts. So as of date, we are very close to 1,000 machines of our own. Our manufacturing operations are fully integrated across the product cycles, with entire manufacturing processes being carried out in-house and coordinated through concurrent design, engineering, machine building, and automation divisions. We are one of the top 10 global suppliers of connecting rods within the light vehicle segment and one of the top 10 global suppliers of connecting rod within the commercial segment for calendar year 2020. Within India, we are one of the leading manufacturers of connecting rods, crankshafts, rocker arms, and gear shifter forks for two-wheelers, connecting rods and rocker arms for passenger vehicles. Specifically, we are the largest supplier of connecting rods, rocker arms, and gear shifter forks for two-wheeler OEMs in India. We are the largest supplier of connecting rods and rocker arms for passenger OEMs in India. On the EV front, Sansera caters to both traditional as well as new age startups in India and internationally, and as we speak, we are also expanding our presence in the CV segment in a much faster pace than what we had initially expected. We are a single source supplier in certain product categories of some of our key customers and enjoy long-standing relationship with several well-known Indian and global OEMs. We have relationships spanning 10 years or more with 12 of our top 20 customers. Within India, our customers include 9 of the top 10 two-wheeler OEMs and the leading passenger vehicle OEMs. Globally, our customers include 6 out of the top 10 global light vehicle OEMs and 3 of the top 10 MHCV OEMs. We have also now added 5 of the Indian two-wheeler OEMs in the EV space, and another 3 of them are in the verge of finalization. With this brief of the company overview, let me now move to some of the recent developments and our performance in the last quarter. To begin with, I am thrilled to share that Sansera has been selected as General Motors Overdrive Award winner in General Motors 30th Annual Supplier of the Year Award. Sansera is receiving this Overdrive Award for the launch excellence of development and support of a 6.2-liter small block connecting rod for full-size truck engines. Just to give you some background about this component, this was being supplied by an American-based supplier to General Motors to their US of North American operations. The supplier went into financial trouble and had to scale down or close their operations. So they were looking at some supplier who could quickly develop and ramp up for the full volumes, and we were selected as the supplier for this connecting rod, and within a very short span, we not only developed this connecting rod but also fully ramped up the production. So in recognition of this effort, GM has selected as one of the recipients of this year's award. This award ceremony will be held in Phoenix, Arizona on the 15th, 16th and 17th of March. This is a global vendor conference of General Motors, and our company will be represented by our Chairman and Managing Director, Mr. Shekhar Vasan, and Mr. Singhvi, our Joint Managing Director. This annual award highlights the global suppliers that distinguish themselves by exceeding GM's requirements, in turn providing GM customers with innovative technologies among the highest quality in the automotive industry. This award demonstrates the robust collaboration and valued partnership between Sansera and General Motors. This paves the way for further opportunities for us with General Motors, both in the ICE as well as EV space. Also, this is testament for our deep domain expertise. We shall be able to expand. With this, we shall also be able to expand our global customer base and win more business. This will also give boost to our plans of setting up a manufacturing facility in US, which is well as planned. We are in the stages of doing a site selection and then feasibility studies of various aspects. Coming to some recent developments in the industry, the economic disruption of the pandemic, and more recently the severity of the semiconductor shortage, rising commodity prices, and the supply chain issues have been causing pressure on the automakers as well as auto component manufacturers. Though still unpredictable, the chip situation is improving gradually. In fact, automobile wholesale continued to grow sequentially across the segments in January 2022. Led by pent-up demand and relaxation of lockdown restrictions. We believe the medium-term outlook for automotive sector remains positive despite near-term challenges which I just mentioned. The passenger segment for both two-wheeler and four-wheelers is expected to remain strong amid COVID-19 as a preference for personal transport is increasing. A sequential improvement in M&HCV sales is expected to continue, driven by an expected rise in the e-commerce, agriculture, infrastructure, and mining activity. EV market, especially in two-wheeler, also continues to gain momentum. Slew of measures announced in the recent budget, including battery swapping policy, creation of special mobility zones, will help enhance EV infrastructure and should propel the adoption of EVs in the country. We are very excited to be part of this journey, where we are also gaining momentum. Coming to our performance and some of our recent developments, Sansera has delivered a better than industry performance with a revenue of 4,868 million rupees and an EBITDA margin of 15.6% despite multiple headwinds in the sector. Our performance in the quarter was supported by the new business. Our CFO Vikas will talk about this in detail in a bit later. Our auto segment. Now I'll hand it over to our Head of Operations, Mr. Praveen Chauhan, to continue this. Praveen?
Yeah, good morning, everyone. So, talking about the auto segment, our auto segment, which caters to global and domestic OEMs across two-wheelers, passenger vehicles, and commercial vehicle space, contributed to around 90% of the sales in Q3 FY22. In terms of current sales mix, if you want to talk about some of these, motorcycles, which dominate domestic two-wheeler space, contributed to 39% of our top line. Scooters contributed to 10%. Passenger vehicles, around 26% of the top line. Commercial vehicles accounted to around 15%. We expect particularly commercial vehicle segment to benefit from this current CV upcycle in India, North America, and Europe. Within our auto segment, auto tech agnostic and EV products across all categories of two-wheelers, three-wheelers, passenger vehicles, and commercial vehicles, etc., contributed to around 6% of the total sales. These products are nascent, yet very futuristic and hence strategic for our growth, as also talked about by Preetam. I would like to highlight that electrification of automobiles is leading to strong demand for the light-weighted aluminum coatings having better strength than casting. We have already taken a big leap into it, and we see a lot of business coming through. Within the non-automotive segment, we manufacture a range of precision components for the aerospace, off-road, agriculture, and other segments, which include engineering and capital goods, bicycles, defense, etc. This segment contributed 10% of the sales in the quarter three. In our current sales mix, aerospace accounted for around 3% of the top line. This quarter was a bit dull due to continuing restrictions around long-haul air travel. However, the outlook for this segment is positive, as we are approved suppliers to prominent aerospace OEMs, and these OEMs are expected to ramp up their monthly production schedules considerably over the next 2 to 3 years. In fact, aerospace is something which we keep hearing positive news from these OEMs on a regular basis. Off-road accounted for 2% of the top line. There is a drop in off-road contribution primarily due to chip shortage. Hello. Agriculture accounted for 3% of the top line, and remaining 2% of the top line came from few other segments. Overall, our business pipeline for future growth is looking quite healthy, with addition of substantial new business in quarter three over and above INR 12.5 billion up to quarter 2 FY22, which we had spoken about earlier in the last one. There is a multiple faceted growth with client addition in both auto as well as non-auto segment. Some of the highlights of quarter three business acquisitions are as follows. New business acquisition is in quarter three is close to around 1950 billion. These are matured annual volumes whenever it happens over the next 2 to 3 years. Exports, very interestingly, exports contribute to around 65% of this, and domestic is 35%. So most of this business acquired is more oriented towards exports. XCV plus technology agnostic plus non-auto, which is a basket that we consider going forward would be important for our diversification, contributes to 49% of the business acquired in quarter three. With this, we have orders from 5 numbers of two-wheeler OEMs, mix of both established and new age ones. So it's very important to say here that we had spoken about that over the next 5 years, up to 25-26, we will be having around 40% overall coming out of XCV, technology agnostic and non-auto. This 49% acquisition is in line to this diversification and changes share of business over a period of time. Very interestingly, aluminum forging, which we started 3 years back, has been contributing big into our business acquisition and diversification. In the last quarter, we acquired around 231 million worth of business from European OEM. We continue to strengthen our share of business in connecting rods with addition of close to around 80 million new business acquisition, which is very much in line with our global aspirations for this product category. Now with this, I hand it over to Preetam for further details.
Thank you, Praveen. On the capex front, as we had announced during our IPO time of our IPO, that our plans for this year would be about 250 crores of capex, and I would like to tell you that we are on track for this plan, because none of our projects that was allocated or anything has neither been delayed or not been cancelled. So we in fact are going ahead with this. The process of setting up a dedicated facility for hybrid and electric components within our existing plant at Bengaluru has progressed well as planned. A few of the lines have already commissioned and the mass production of these has begun in the quarter 4. We have also filed an application under the PLI scheme for automobile and automotive component industry. The review of the same has already started. Further, we are constructing, as you are aware, that we are constructing a greenfield manufacturing facility in Bengaluru dedicated to aerospace and defense. And government's initiative of opening of R&D defense for auto component manufacturers should benefit us in this long run. Here, I would like to add that there is a lot of traction that we have got in, defense sector. We have been able to add multiple customers and very, very critical components, including the ones for light duty helicopter for components for HAL. I would like to mention here that our first chairman, Mr. S.S. Vasan, father of our current CMD, who was also a radio engineer at HAL. So for our chairman, this defense and working with HAL is very close to heart. So we have been very excited on this journey. As a commitment towards the environment, we have done a tie-up, further enhanced our tie-up with CleanMax with 30 million units of renewable energy getting added to our Bangalore plants from FY23. Currently, excess of 50% of our energy requirement for our Karnataka plants is being met through renewable sources, and with this addition, we will exceed 80%. Ultimately, our plan is to exceed 90% power purchase through renewable energy. And on our a lot of work is being done on ESG front also, with multiple of our customers doing audits and also giving a thumbs up for our efforts on this direction. Now I'll hand it over to Vikas Goel, CFO, to talk about the financial highlights. Vikas.
Thank you, Preetham. Good morning, everyone. Welcome to our 3 and 9 months performance in terms of financials. So our total revenue stood at 4,868 million for the quarter, and which is 3% decline against the same period last year, which actually is a decline in the other operating income. If you look at our revenue from the automotive sector, it was flat during this period as against last year. Typically, we would have expected a growth in this, but despite a reduction in the served markets, we've been able to keep this flat, which is, I think, very, very encouraging for us. We also saw an increase, and we have been seeing an increase in the raw materials cost in the past few quarters. However, we were able to pass on these increases to the domestic customers immediately, and in some cases, these increases are being passed on with a lag to the OEMs. Approximately 3-month lag is what we are facing. So there may be a bit of movement in those numbers because of this lag. If we talk about our gross margins, we had a decline of about 3.4% on a year-on-year basis for the quarter in our gross margin. And primarily 3 reasons for it: lag in the price increase, as I mentioned earlier, on domestic sales. Numerator-denominator effect on the pass-through of the raw material prices also moved the needle to some extent, because the cost and revenue both increased by the same value. So it impacts the margin percentage in an optical way. The decrease in operating income, as I alluded earlier, is the one-time effect for this quarter. The slight squeeze in the margin on the international revenues due to higher raw material prices. So in some of the cases, we use domestic raw materials for our export customers, where we are not able to pass on. So this has a marginal impact on our margin with export business. Going forward, we expect this to correct over a period of time. Our EBITDA stood at 759 million against 1043 million for the same period last year, and the margin stood at 15.7%. The EBITDA margin drop was primarily guided by the fall in gross margin, as I mentioned earlier, and the employee cost increase due to salary increments given this year, as well as provision for the ESOP costs that we accounted during the third quarter. This was partially offset by lower other expenses, which we were able to optimize. And we believe going forward with the expansion in the volume, the operating leverage should kick in and we should be able to improve it. The quarter also registered slightly higher finance costs due to increase in the overall debt to fund some of the capex. Though this was partially neutralized by lower interest rate, which we have been able to negotiate from our existing lenders. Besides that, the export finance cost, the rupee-denominated export finance cost, we had an increase due to discontinuation of the interest equalization scheme by Reserve Bank of India during third quarter. And we expect this to also get neutralized because now we're switching back to foreign currency denominated packing export credit, which basically will help us to neutralize this impact, and this also should come back to a normal scenario as we move forward. Our profit after tax at 239 million against 506 million was a degrowth of 52%, and it's primarily driven by the reasons which I mentioned earlier. If we talk about the 9 months performance, revenue stood at 14,237 million against 10,764, which is a growth of 32% on a year-on-year basis, and notably the automotive sector sales grew about 34% out of this. The highest sales came from the passenger vehicle sector in this period. So basically on a longer period, if we say is a more normalized period of 9 months, the story or the credentials are intact so as we see at our markets and our business. Our EBITDA also grew by 31% on a year-on-year basis for the 9 months period at 17.5% versus 17.7%. And we believe that going forward with the expansion in volumes and correction of some of the factors which impacted us during third quarter, we should get back into normal range. We incurred a capex of about 180 crores during this period of 9 months, which is in line with our commitments and our growth plans to the customers. And we are on track to achieve or to establish capacities which we mentioned in the during the time of our IPO. In terms of the geographical sales mix, for the 9 month period, India accounted for about 63%, customers in Europe at about 24%, customers in North American region about 10%, which is a 3% increase against the same period last year, which also indicates the growth of our business in that region. And it actually gives us immense confidence for the way forward. On the debt front, our total net debt stood at about 600 crores, and with the expansion of operating cash during fourth quarter and certain other measures that we are working on, we are confident that we'll be able to reduce this very close to our year-end target set at the beginning of the year. With that, we conclude our presentation and open the floor for question answers.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Nitin Agarwal from Axis Mutual Fund. Please go ahead.
Hi, sir. This is Nitin Agarwal from Axis Mutual Fund.
Nitin, you're not audible. Can you request you to use the handset, please?
I'm audible now?
Yes.
Yeah.
Yeah, Nitin, go ahead.
Your voice is breaking. Request to please also come in a network area.
So the first question I wanted to ask you is on this new order inflows, that has been very strong. So can you throw some light, because there are a lot of orders we see on the presentation from the two-wheeler electric players. So is it largely domestic, or is it more also coming from the export market? If you can dwell that a little bit on that. And the second part of the first question is, if you also can dwell on the defense side or the how have been the order inquiries or order panning out there? That would be helpful. That's my first question.
Yeah, Nitin, Preetham here. Good morning. So the first question, to answer your first question, the new order inflows from the electric two-wheeler market has been primarily as of now with the domestic market. But then when I say domestic market, it includes both the new age startups as well as established OEMs. We have been now with 5 of the total OEMs with confirmed orders. This also includes a joint venture between an Indian company and a European major. And I guess these are for both domestic as well as export markets. We are also in the process of finalizing, components with other 3 OEMs. So the traction in the electric vehicle segment, especially in the two-wheelers, has been quite encouraging for us. This includes both steel as well as aluminium forged components. So this has been quite a good journey. Now I'll leave Praveen to answer the second question, where non-auto and defense. Praveen, can you take the second part of the question?
Yes, sure. Just to start with, I think we had included in our earlier presentation also that in quarter 3, there was a big focus onto the business acquisition towards exports. So 65% of the business that we acquired was export and 35% was domestic. And overall, if you look at it, auto ICE, which is particularly something which we have been trying to diversify from, auto ICE contributed to only 51%, and the rest 49% was a mix of EV, tech agnostic, and non-auto. Among this 49%, 34% is XEV and tech agnostic, and 15% is non-auto. So all put together, if you see, 49% is a basket of area where we have been trying to aggressively diversify. And this is not only quarter 3. In fact, if you look at the data of 12.5 billion that we had given earlier, which is an acquisition till quarter 2, that also has incidentally a similar distribution, 51% auto ICE and 49% out of EV, tech agnostic, and non-auto. Incidentally, non-auto there up to 12.5 billion was 22%, and EV and tech agnostic was 27%. But now you see there is a move towards EV and tech agnostic, which has grown from 27% to 34%. This is all in line with what we had spoken about earlier, what we had been talking about, that we are aggressively diversifying, and our plans to reach 40% plus with a contribution of EV, tech agnostic, and non-auto. And one more thing, we spoke about two-wheelers. Two-wheeler content is regularly diminishing. Though we continue to strengthen our position in two-wheeler, but then our business acquisition is more coming out of other areas. So in quarter 3, two-wheeler was only 30%. To answer the question.
Yeah, Nitin, Preetham here again, and just to give you some flavor on what we are working with different customers in different areas, is that we are now doing parts for multi-surveillance radar. Then we are doing parts for 30-meter telescope parts. For the titanium wing, parts of titaniums for hypersonic technology demonstrator vehicle. There is also tail unit components for tail unit. We are doing some pylon beams for the fighter jets. It's also for light utility helicopters. We have started machining conical housing, stiffeners, frames. So there's a lot of movement in defense. I'm sure that you understand that the journey has just begun, and it requires a lot of effort, also coordination between different agencies. And but the way that the things have progressed in the last few quarters, after we decided that we will start looking at defense as well, has been quite encouraging. The journey has been very, very encouraging.
So, sir, just one more highlight, we had spoken earlier also, was that aluminium forging, which we started 3 years back. And we knew that this is going to have a lot of traction because lightweighting in EVs is going to be very important. And while aluminum castings have been there in the vehicles, but then there is a limitation to the strength. And aluminum forgings bridge the gap with the lightweighting and the strength also being there. So in the last quarter itself, there has been a big business acquisition of 231 million from the European OEM. Mm-hmm. And we see a lot of traction, a lot of interest, a lot of RFQs are flowing in. And we are quickly doubling our capacities. In fact, we have to continue to keep on investing into this area. So that's very interesting and very in line with what we had expected market to be changing towards.
Got it. So just dwelling one more thing here, because last quarter we had new orders in the pipe in our kitty was about 1250 crores, 200 crore we have received in this quarter. So about 1450 crore is apart from the base business, are the new platforms, new order, the electric part is there. Now, given the inquiries and the momentum which you're talking about, is it possible to give some direction this momentum will continue? There are a lot of bidding which is coming into the new platforms, both like the way you said in aluminium forging. I'm asking this question more from two angles. One is, I'm assuming out of this total new order inflows of on an accumulated side of 1450 crores, some would have gone into production. I don't know how much would that have been gone, 5 or 10% of that. But just on the direction side, are there more bidding coming up, in the electric two-wheeler plus the way you're saying aluminium forging, which can keep us the momentum of the similar kind of order intake which you're seeing?
Yeah, Nitin, actually, just to add to what you have said, that look, aluminium and EV has been a new journey, and we have added, as I said, whatever we have added apart from in EV. But then apart from that, in aluminium segment itself, now we have 7 customers with whom we are working, both international and domestic, and the journey has just begun. The way that things are looking and RFQs are flowing. As last time also I told that we are adding capacity into aluminium. We have ordered for another 1,600 ton press. We are finalizing one more fully automatic 1,600 line from an European manufacturer, and we are looking at adding another 4,000 ton press for aluminium, because the kind of momentum that we see in this components is significantly higher. Just to give you on what kind of work that we are doing on this, as of today currently we have about 255 components under various stages of development. This doesn't include aerospace components. It includes only auto and non-auto other than aerospace. And we are also working on close to another 300 components on various stages of RFQ. So there is significant increase in the number of RFQ flow. In fact, we are expanding our team, because please understand that as we have entered different sectors of non-automotive and different product lines, the number of components and the category of components have increased. So there was a lot of work is required to go in with estimation, engineering work and all that. So we are finding it that that's a big constraint as of today. There is a significant increase in the inflow of both RFQs and the order wins.
Got it. Just dwelling one more point on the margin side and the execution. So we saw that in other production data of global OEMs, December was very bad actually. When we look at the production data of European OEMs or let's say the US OEMs, India also was impacted. If one has to take a direction in terms of, because you have a back here, the new businesses plus business, how one should build in the revenue of the execution, in your view for FY20. Throw some light on the direction side. I don't want the exact numbers. And margin.
I am losing you, Nitin.
Agarwal, I would also request you to join the queue for the further follow-ups questions.
No, actually, yeah. I couldn't hear his question fully.
Mr. Agarwal? It seems...
I'm audible?
Yeah, no, we couldn't hear your question, Nitin. We got lost.
My question. So the question was, sir, on more the execution side, because given what you are receiving every quarter, the order inflow looks very strong. And I understand, December was a very close month for a global OEM, whether it's in Europe or US. How one should build the execution going forward? If you can throw some light on FY23. I don't want the exact numbers, but generally your sense of, taking into account the chip issue for your clients, how one should look at the FY23 revenue. And, in terms of margins, is something we are near to the bottom on the commodity price, the price lag should come in. So how one should look the margins part as well? If you can throw some light, that'll give confidence.
Yeah, I mean, Nitin, though we have said that, a lot of OEMs coming out and saying that, largely the chip crisis is behind us and things are looking very positive, especially if you have looked at General Motors, Suzuki, even Toyota saying the same thing. So we believe that the way forward would be much, much better in terms of availability of the chip. At least this is what we hear from global customers. But I would be cautious to say anything as of now regarding the FY23 numbers. I would prefer that, we go through this year and during our full year call, which will happen sometime in the Q1. So I would probably be more confident of talking that because, the next 3 months would give us a significant, the direction would be much clearer. But having said that, the March quarter would definitely be at least if you look at January numbers of a lot of OEMs, there is the things have been much better in terms of our export customers, which we had a tough time on November and December, where you said December, but we also had November and December was very weak, especially for passenger vehicle global customers. So we had literally cancellation of a lot of schedule lines and order inflow. So, but that has come back to mostly normalcy. So, considering this factor, and I don't see any further restrictions because of the Omicron, we all hope that this is behind us. We should be able to, this year, we are expected to have a good quarter in the Q4. And, looking at the overall year numbers, we will deliver better than 20% growth on a year-on-year basis on top line. And, in terms of EBITDA, as we have always mentioned that it would be a range bound, we will still be for the full year anywhere between 17.5% to 19%. I would not like to really comment anything further on FY23 numbers.
Thank you. Mr. Agarwal, request you to join the queue for any follow-up. A reminder to our participants, please press star and 1 if you wish to ask a question. Also, before we move to the next question, participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. Our next question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on winning the Supplier award from General Motors. So if you look at the order wins, we have seen a very good traction from the export part of the business. So you also highlighted about potential multiple new orders coming from GM probably sometime later as we scale up further. So if you can help us understand this slightly better, how big potential can we look at from GM and when can that potentially come for us? And in terms of margins also, how should we look at some of these export orders?
Thank you, Siddharth. Happy New Year to you as well. Siddharth, yes, this working with all the global OEMs, especially on precision engineered category and all these years, powertrain was supposed to be one of the toughest ones to crack because either it was done in-house or they would prefer that that very established players would only do that. So initially it was a big hiccup for us. We tried for almost a decade to get into major OEMs of North America. Our first interaction with GM was almost a decade back, and we were only able to get some orders, very small orders, that too for a couple of supplies for Europe and North America from GM couple of years back. But this couple of orders win last year, which actually resulted in one of the OEMs, one of the Tier 1s going down, and the thing has really increased the confidence of our customers on us. We were able to deliver it within a very short time, and not only that, as I have been always maintaining that since we have a fully integrated facility and our machine building capability allows us to ramp it up much faster than ideally if we were buying it from outside. We were able to execute it much faster, and this has helped us definitely not only to win this award, but people are now much more confident of us as a supplier to these critical components, be it on powertrain on the regular components, but also on non-powertrain components, which goes into either braking systems or onto driveline systems or a new electric vehicle aluminum. So there's been a lot of traction. We are working on a few of the very big RFQs from these things. I can't really reveal what is the size and big, but we are very confident that these should also propel our journey into setting up of this facility in US, which we are talking about, because we see a lot of traction for our work that what we have done.
Understood, sir. And when we say about this facility, how does it mean for our capex? As we have guided about, say, 750 crores capex over the next 3 years, does this capex change some of these numbers, or it will be inside this only when we talk about capex?
No. This is very much inclusive in the plan, because we have had this plan for the next 3 years, and we have already taken kind of a number for this facility in US. But let me tell you, if the kind of RFQ that we are working on, of course, if we have win these things, it would increase the capex, but it's too early to say. We have taken up a portion of this thing in our estimates already, but not fully, because it was it's very difficult to estimate when we say how much of this. So initial capex has already been estimated.
Got it. And my last question will be on the EV order wins which we had. Would it be possible to understand what will be the, on an average, kit content you will be supplying, value, say, per model you will be supplying to some of these new orders, new clients which you have won? So just to understand if the volumes are higher, how big can this potential be?
No, actually, Siddharth, I think, there are two aspects to the journey into EV. One is, winning the customers and then increasing the content per vehicle. Now, the step is, the journey has already started. We have added 5, totally we have now 5 two-wheeler EV customers into our thing. But, there are customers with 2 components as of now, confirmed orders. There are with 3, and there is with one of the customers has got 1. So there is one customer with 8. So there is a different content, but it is very premature to put it across that what is it. But, we still maintain that addressable market for us in a EV as of today, what we understand is between 5,000 and 6,000 rupees per vehicle, and we are on the process of expanding those components with each of the customers that we have started working on or winning this. So please do understand that the journey has just begun, and with the kind of work that we are putting in and the components that we are developing, we are quite confident of our content per vehicle surpassing the content per vehicle easily of the ICE scooters.
Okay, sir. Thanks a lot. I'll come back in.
Thank you, Siddharth.
Thank you. Our next question is from Joseph George from IIFL. Please go ahead.
Hi, thank you for the opportunity. Am I audible clearly?
Yes.
Next, please.
Thank you. I just have 2 or 3 questions. So one is, you mentioned that overall you have orders from 5 EV OEMs. I wanted to understand how many of these OEMs have contributed to your EV revenues in 3Q?
I'm sorry, Mr. George, we would request you to stay connected while we reconnect the management line. Other participants are requested to please be on the line while we reconnect the management. Thank you. Ladies and gentlemen, thank you for patiently waiting. We have the management line reconnected. Mr. George, I would request you to please once again repeat your questions. Thank you.
Thank you. This is Joseph. The first question that I had was in relation to the EV orders that you mentioned. So as you mentioned that you have EV orders from 5 distinct OEMs. I want to understand how many of these OEMs have contributed to actual revenues in 3Q? To EV revenues in 3Q?
Except one, the others are under development and the thing. So nothing much has come from the other 4. It is just order wins that we have now. We have 4 confirmed orders, 4 customers with confirmed orders where the revenue is yet to start. Only one customer with whom we have been working, the revenue contribution has been recorded in Q3.
Understood. Thank you. The second question that I had was, you mentioned something about a sharp fall in other operating income. Could you give out the numbers for other operating income in 3Q this year, 3Q last year, and maybe 2Q of this year? So this quarter, YY and QQ.
So the other operating income items that we are referring for this fall is what about 11 crores. Last year, and it was 3 crores this year. 8 crores differential there.
And how much was it in 2Q?
2Q, it was about 11 crores again.
Okay. And is there a particular reason why this has fallen? I mean, going forward, we expect it to bounce back to 11 crores, or is this the new normal?
So, a significant portion of this is on account of the tooling or development cost that we charge to the customers, and this is not a regular thing. But considering the kind of new business that we are signing up, we see a stream of these tooling invoicing to go up in future. The second element is regarding the export incentives, especially the MEIS scheme, for which the rate got slashed in the past. From January 2021, and that's where it's a kind of a permanent reduction that we will see going forward.
So Joseph, just to add to what Vikas said, we do not expect too much of change going forward. So the tooling cost there will be a constant flow, because this is just termed as tooling cost, but this would include a lot of engineering costs, a lot of proto development costs. So this will continue to be there. This is one of where a lot of our OEMs were also closed, so the inflow was also curtailed.
Understood. Thank you for that. The next question that I had was in relation to the domestic pass-through, where you mentioned that typically it happens automatically or with a 3-month lag. So what I wanted to understand is, given that we have seen some stabilization in prices of raw materials, do you expect this lag impact of the rise in RM and the resultant impact of that on the gross margin and the margin to completely normalize next quarter, or will it take a couple of quarters before it completely normalizes?
No, it would not completely normalize in the next quarter because there are still a small amount, still one more rise is expected which is actually not accounted for in this. So there would be some small impact. It would not be so significant, but there would be some impact. And post that, I expect that things to get normalized.
Understood. And Peter, can squeeze in one last question. You give out the revenue breakdown of into say, auto ICE and EV plus non-ICE, etc. Would it be possible, at least for this quarter, to tell us how much is pure EV revenues in the quarter in terms of percentage of revenue?
Praveen?
Joseph, you're talking about quarter 4?
Quarter 3.
Quarter 3. If Santosh can help us, I don't have the numbers.
I'll come back to you before the end of this, or I'll answer to you separately because I have this numbers and have to pick it out.
No problem. Thank you. Thank you for your responses. I'm done with my questions.
Thank you.
Thank you.
A reminder to our participants, please press star and 1 if you wish to ask a question. Our next question is from the line of Kapil Singh from Nomura. Please go ahead.
Yeah, hi, good afternoon, sir. Firstly, I wanted to check on this order book. We've talked about close to, I guess, somewhere close to 1,400 crores kind of order book. Over what period can we expect this to flow through into revenues?
Kapil, as I said that, these follow some 5-6 year cycle and generally towards the end of the second year of the product startup cycle, it will start peaking out. So I expect that, from 2 years from now, 2 to 2.5 years from now, we would see the full impact of this onto our revenue mix.
Okay. And would something go out of the revenue as well? Is this net or this is gross number?
Yes, it would. It would not go out of this, but it would go out of our regular business because some of the models would discontinue. So what we will do is at the end of this year, we will put out a statement as to what is going to be the net of order wins after considering what business would go out for the next, say, 2 to 3 years period. We will mention in what period it would go out and then how much is the ramp up. So we will try and put that matrix towards the end. So that is what we have decided. Like last time also I said, we will reset this matrix every once a year.
Sure, sir.
So, Kapil, just to add what Peter said, generally speaking, we have not included the business which is a replacement business. Wherever we know that this is going to be replacing an existing model into a new model, but there could be some segmental change where we don't know what the replacement is going to be. There could be some elimination which might happen, and there could be some elimination which is the business which is likely to have peaked out in this current financial year. But not much on the minus side of it because we have not considered replacement business into this new business activity.
Okay, so just to understand this hypothetically, if let's say a model A goes to a new, let's say a new variant of that or a new model is launched, let's say an old Alto is replaced by a new Alto, that would you count that as new order or you don't count that?
No, we don't, because there's been a lot of commonization and standardization happening in the customers, like for example Maruti you spoke about. So if one model connecting rod is converting into another connecting rod, which we know or which we're already doing, so we don't consider that incremental number from one to another as a new business.
Okay, because then this order book looks fairly strong, right? I mean, from basis the current run rate, even if it comes 3 years out, we are looking at probably 65 to 70% higher revenues than what we are doing today.
Yeah, Yes, Kapil, just to give you an idea as to, like, see, today in the automotive, apart from aerospace component, in Sansera India, in the auto and non-auto other than aerospace, we have something like 750 plus components which are active where it is generating revenue for us. And about 255 components are under various stages of our development, which is not generating any revenue as of today. And there is significant amount of RFQs that we are working on. So there is a very strong order book and business pipeline, which also dominated by the non-auto and XEV business as well, as Praveen has explained. So there is a mix that is getting changed, but the optical impact of all these things will of course take time, because the auto business is also growing, and the way that we are adding non-auto and XEV will take some time, because the maturity of the business will also take some time.
Sure, sir. And the second question relating to these order wins only is, if we look at your own capabilities in terms of when you look at aluminum forging and the number of RFQs you are working on, how are you developing some of those capabilities? For example, I know you are a lot focused on design and engineering kind of capabilities, right? So what kind of, I believe there will be a lot of software requirement also to develop these components. So in terms of your, how you are developing those capabilities, also if you can talk about how competitive you are when you look at the global scale, right? Because now some of these areas you probably can be competitive on the global scale as well, right? So how are these applicable for winning global orders, or potentially, the kind of asset terms we could have if we were to, for example, do the same business, say outside India, is that an opportunity as well?
Kapil, some of these new components, especially on aluminum forged line, where we have been working on, and this order that we have received of overall over 10 years, about a 250 crore order, which is consisting of about 13 parts for a European major. And this the thing is on the extreme end of requirement in terms of both aesthetics as well as the thing. So while we are, our capability on special treatment, on heat treatment, all these things are getting fast developed and added. This also, as you rightly said, would also require some more capabilities to be enhanced in our, simulation and rapid prototyping division, which we are working. We are also enhancing our team's capability. We have dedicated teams now working on new age materials, not only aluminium, but also on high strength new steels, microalloy steel. So there is a lot of work that is going on our engineering as well as on the facility side as well. We are working with one of the European suppliers for putting up a fully automatic 1,600 ton aluminium forging line, which should get finalized in a couple of months. And as I said that we are also now on the verge of finalizing a 4,000 ton press. So we see a lot of opportunity. As far as the competitiveness is concerned, I guess that, the very fact that we have added now 7 customers to this and a lot of RFQs are being worked out, we are probably cost competitive, but it's a bit of a initial momentum for us where we need to also digest a lot of cost and working on this. So we are quite hopeful that this would also be a very, very strong line of business for us in the years to come.
Thank you. Our next question is from the line of Homer Irani as an individual investor. Please go ahead.
Yeah, my first question is with regards to your new order pipeline, when will they start contributing to your revenues? Will it be next quarter, and in what quantities will they start? That means, at what percentage will your revenues grow, let's say next year, due to the new order pipeline? Okay, and the second question is, how do you compete? How is your proficiency vis-a-vis MTAR technologies. They make those hot fuel boxes for Bloom Energy. They make actuators for ISRO and assemblies for ISRO, as well as for atomic power plants. I think BARC or some nuclear Corporation of India, they make fuel rods and actuators. So they are also making these import substitutes, which are those roller screws and ball screws. So how is your competency? Can you compete and match customers of MTR technology?
Yeah, see two portions. I think the first portion of the question is when it is going to start fully contributing to our revenue. I have already answered that, to fully realize the order book that we have, as what we have indicated today, would take closer to about 2 years and more. But then having said that, out of these order books, there are various components which have already either have started or are going to start in this, like hybrid components for our Japanese OEM is going to start from the first quarter of the next year. Some EV components have already started. So there is an incremental revenue that is getting added into every quarter. To quantify that at this point of time, I may not be able to do it. As far as the capability to work with, the other sectors like nuclear or, you said high precision ball screws, every sector has got its own challenges. As far as we are concerned, I'm very, very confident that with the kind of expertise that we have on processing of various materials, which includes but not limited to stainless steel, titanium, aluminium, and with our capability of in-house fully capable heat treatment solution that we have with various heat treatment processes in-house, and now we are setting up a surface treatment as well. So we should be capable of doing these components, but then we haven't yet ventured out into any of the nuclear or related activities as of now. Our focus has been now working on the defense. We will slowly expand our thing.
And what about the medical devices that you mentioned on your website? What kind of medical devices would you be getting into?
No, we actually have started working with one of the OEMs. We have developed certain components, but that work is going slow. But because I have already explained that there is a significant increase in the number of RFQs in our auto and non-auto field as well as our aerospace and defense. So the resources are getting engaged into that. We have taken it slightly slowly. We have developed a component for this, but not much of work is being done as of now because we need to really augment our resources into handling what we are getting now.
Okay. Thank you. That's all for this.
Thanks a lot. Thank you, ladies and gentlemen. That would be our last question for today. I now hand the conference over to Mr. B.R. Preetham for closing comments. Thank you, and over to you, sir.
Thank you, Aman. Diversification has been an integral part of Sansera's journey since the very beginning, and we endeavor to continue on this path by addressing select high-growth business segments to expand our customer base and addressable markets and develop new business by leveraging our current capabilities with capex fungibility. Some of our recent order wins in EVs, suspension parts, aluminium parts, etc., underscores our strength in these upcoming areas. We are very optimistic with the response that we have received in the EV space. We have already secured business from traditional OEMs and new age startups in the EV space. We are committed to broaden our revenue base in the long term with non-auto and technology agnostic components, contributing a much bigger share of revenue pie. In the long term, I would like to reiterate the fact that the company is targeting an enhanced revenue base with an auto ICE contributing about 60%, auto tech agnostic and XEV contributing about 15% and remaining 25% being non-auto. With this, I conclude the call. And if you have any further queries, please contact SGA, our Investor Relationship Advisors. Thank you everyone for joining us today on this earnings call. Keep yourself and your family safe in this difficult time. Thank you very much.
Thank you very much.
Thank you everyone.
Thank you. Ladies and gentlemen, on behalf of Sansera Engineering Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.
Thank you.